Good morning. Thanks for your patience with that. My name is Zach Hurst. I am a certified financial planner in our Chattanooga office with the Trust Company of Tennessee. On screen with me today, Miranda Carr, who is our Chief Investment Officer. This is probably my favorite Retirement Plan Academy topic we do every year because I learn about everything Miranda's been doing for the last 12 months and the hard work that she and her team do in order to look at the forecasting in the future of the markets and where our best thinking is, and talk through that with you, many of you plan sponsors on 401k plans, and help you understand what we're looking at as we head into 2024. So with that, let's get to my screen. Bear with me one second. Somewhere on your box, you're going to have a questions or a Q&A. I think it's labeled within your team screen. That's the space where you can enter questions as we go. And Miranda, what I will do is try to tackle those as we're going. If not, we're certainly going to leave some time to have those afterwards. So again, if you have questions as we go, please enter those. I know I'm going to have some questions as we go, so I'm going to jump in, Miranda, on some of these slides that you're going to be talking about and have a little fun and see what's happening in the world of investments. So let's jump in. Investment themes, and thank you all, by the way, for being here. I know many of you are clients who are on the call within our 401k operations. You've probably seen Miranda do this at least once a year. You've also seen her on different videos that we put out about how we operate as a company as it relates to the investments and our investment selection for you and your plans. So glad you're here. For those who are not clients, probably friends out in the community, thank you for joining as well. For those who don't know who we are and you just somehow randomly ended up here, we are a financial planning firm in East Tennessee. One of our big focuses on 401k and retirement plan space. So we're going to cover that today. Miranda, I'm going to jump in with the economic review.
Fantastic. Thanks, Zach. Good morning, everyone. Just going to start by kind of recapping where we are today. So 2023 is over. It was widely expected that we were going to see a recession in 2022 and then 2023, and that didn't happen. It doesn't mean that we're not going to get a recession at some point, but really trying to time one is not what we're in the business of doing. Recessions happen in the normal course of a business cycle, and if you just stay invested over the ups and downs of the market, you tend to do better. So we are in the middle of a strong economy still. Inflation is coming down, and the Fed is expected to lower rates this year. One of the main headlines of 2023 was some of these stocks in the S&P that had done phenomenally well as part of the AI boom. So companies like Nvidia, Amazon, Google, and so forth. So that kind of dominated headlines because they led the market. A lot of the other companies in the market was down, but that did create an opportunity in other spaces that didn't see such a rally, like U.S. small caps and international stocks. So we'll talk about that later on. One of the things that we saw in 2023 was a lot of volatility in the bond market. And this is because there is a lot of mixed messaging or even different views on what the Fed was going to do. They continued to hike rates throughout 2023. And what you can see here on this chart here is the yield curve. So this is just interest rates from 0 years in maturity to 30 years in maturity. The dark blue line is where we ended 2023. The orange line is where we ended 2022. And so if I can point out the 10-year, this is the 10-year interest rate on the Treasury. It went round trip. So we started at 3.88%. We went up considerably throughout the year. And then in the last quarter of the year, came back down to close the year at 3.88%. The front end closed up a little bit higher. The Fed has a little more control over that. But it did move around a lot during the year despite closing at 3.88%. We also saw a dispersion, like I mentioned, among those magnificent 7 stocks, which were up on average over 100% in 2023. So really phenomenal performance. What we're showing on the chart below is measures of valuation. And so the S&P 500 is a market cap weighted index. And that just means that the bigger companies make up a bigger share of the index. If we were to equal weight all of those companies in the S&P and look at the valuations there, that's what's shown in the blue line. So if every single company made up the same percentage of the index, that's where the valuations would be. Because that's not true, because it is a market cap weighted index, the bigger companies with higher valuations make up a bigger part of the index. And so you can see over the last few decades, we're at the highest kind of dispersion or gap between those two numbers of the equal weighted number and the actual market cap weighted number. And that's important because it shows that those top companies are driving up valuations, but the rest of the index actually still looks pretty healthy. So I actually think this is still a good story for the S&P 500 in the US market, and that there's a lot of opportunity of companies like Walmart or CVS that didn't go up so much, that have some room to rally here. And part of the reason why investors have been so concerned is because of the Fed. So the bottom right-hand chart, you see the real Fed funds rate. And when we talk about real rates, we're talking about stripping inflation out of the nominal or the stated interest rate. So if you're thinking about the stated interest rate, maybe on a CD, it might be 5%. And if you back inflation out of that, which is about 3%, you're looking at a real rate of 2%. So this is just when real rates are positive, that's considered restrictive territory when the Fed is really trying to slow down growth. And you can see since the financial crisis in orange, we haven't been in restrictive territory. The Fed has been able to keep interest rates low as inflation has been really low. As inflation has come up, interest rates have also come up. And so we're finally to the point where inflation should be coming down, and it is because we've moved into this restrictive territory. So that's a little bit about what's going on today.
And one question on this, and just for those in the room here, my role within the company as it relates to retirement plans, 401k plans, is to be the advisor on the ground, talking with your participants and hearing what their concerns are and walking through their investment portfolio or just general financial picture and concerns. And so, anytime people start to get a little bit tense about what's going on, Miranda, the gut reaction is pull me out, get me in cash. I'm scared. I'll jump back in when I feel better. And of course, our message is, and we'll get to this in a little while about why, is not a great idea. Again, we'll cover that in just a minute. But one thing that we have had a lot more questions from people who are more educated within the markets is, okay, I get it. I'm not supposed to get out, but I am still a little bit nervous. Are bonds a good place to be? Am I catching some kind of a bond rally? And we look at what happened in Q4 last year, where we were headed towards a third straight year of negative returns, unprecedented third straight year of negative returns within fixed income until a big rally. And as we see the Fed messaging of rates might be cut 2-3 times this year, are we pretty bullish? Are we pretty positive on what bonds could do in 2024?
Yeah, I think so. And we have a slide coming up
Okay,
later on the deck that talks about our expectations for returns for fixed income, which are markedly better than they have been over the past few years, for sure.
perfect. All right, get into components of GDP growth and try to
Yeah,
make this
so
one interesting.
yeah, so the reason I included this is I just wanted to kind of point out that we have seen positive economic growth. So in the US, we measure the economic growth by GDP primarily. And the way we measure that is on a quarterly basis. So how fast did the economy grow during the quarter? At what rate were we growing? And the trend line has been 2% over the last several decades. It's kind of the target of the Fed. They're trying to get to 2% growth. Of course, during the pandemic, we were well below that. We had negative growth. We had a contraction in the economy. And you can see the big bounce back in 2021. So at the first quarter and second quarter, where GDP growth was up considerably. We were expecting a slowdown, and we did get a slowdown from those really high numbers in 2021, but the economy is still growing at a very fast clip. So this data shows that at the end of or during the third quarter, the economy grew at a rate of 4.9%. And since then, most recently, we got the data for the fourth quarter. And during the fourth quarter, the economy grew at a rate of 3.3%, which is still above that kind of 2% target trend growth. And I think that focusing on some of these components is important too. When we had the pandemic, a lot of the growth that we did see was fueled by government spending. So the government stepped in, we sent stimulus, and people were not consuming, right? They were staying home. They weren't going out to restaurants. They weren't traveling. They probably weren't even working in a lot of cases. And so we did see a really significant rebound in 2021 when people were getting those stimulus checks and their paychecks and feeling comfortable to go out and spend. And so that big green bar is a really healthy economy when consumption is driving growth and not government spending. So we saw that again, kind of return to more normal levels in the third and fourth quarter of last year, which really just sets us up for pretty good growth in 2024 as well.
And moving into the drivers of economic growth, what I like about this is it says long term, right? And so when we talk about 401k plans and people who have this money building for and into retirement, these are long-term financial plans that we're working on our participants with. And so I think trying to focus on what those long-term drivers are is a big impact of how we deal with participants. Maybe Miranda, not at the detail you're about to provide, but jump in here and let us know what we're looking at.
Sure. So I'll actually start with the chart on the right-hand side. So this shows the growth in real GDP, so the economic growth over the decades, going back to 1950. And so when we talk about that 2% trend, you can see since 2000, we've been around 2% growth. And the two components of GDP growth are the growth in the labor force and then the output per worker. So how productive is our society? How productive is our labor force? And is the labor force growing? And part of the tough story here is that top left chart, where we have seen a reduction in the growth in the working age population. So after the financial crisis, you can see both the native born population has been declining as well as the immigrant population. And so what we really need to see is productivity growth pick up here because we're not seeing a growth in our labor force for lots of reasons, right? So demographics is one, but immigration is also another. The good news is that bottom left chart. So capital spending. So these are the investments that companies are making in either research and development or equipment, so computers and those probably AI now. And so that orange line ticking up now is a really good sign that while our labor force might be slowing in growth, they're going to become more productive. And we've actually seen that in the data. We've seen productivity tick up over the last few years. It remains to be seen whether this is just a short-term post-pandemic effect that we're seeing, or if it's because during the transition from the pandemic with work at home, people just became more efficient at doing their jobs. And so that's kind of the hope, and that's what the data are showing as well.
That's interesting. So the census forecast on that top left about growth in working age population still has it coming even further down over the next
Correct.
10 years. We didn't prepare for this, so if you don't know it, it's okay. But did they list the reasons as to why it's coming down so dramatically?
Well, the demographics, of course, we have an aging population. We have fewer births, so the birth rate also is lower. But then also immigration. So some of the countries that we saw the most immigration from, their economies are actually doing better than they were 20 years ago. And so they're not as keen to leave and come here for other opportunities. So lots of factors. It's really complex problem. Those are a few issues, but by no means encompass the whole problem. But those are a couple of the reasons.
Yeah, I really like this one and then this slide as well because I think that a lot of the people on this call and those that we deal with are. It just so happens that most 401k plans or retirement plans fall within the HR space, and so I think that probably those on the call are pretty interested to hear what we have to say about workforce and what it looks like in the labor market. So take us through this one, and then we will probably jump back into more investments.
Yes, sure. So this is just really interesting to me, especially when you think about the tight labor market that we've seen. You hear from everyone that it's so hard to hire, it's hard to fill spots that you have open. And that's because we do have a really tight labor market still. The unemployment rate is around 3.7%, and anything less than 4 to 4.5%, it's just nobody's unemployed, right? Everyone's working who wants to be working. And that's not because people are staying home. We actually have more people employed in the US today than we ever have in history. So if you look at the actual number of people employed, it's above 160 million, which is more than pre-pandemic. So lots of people working. And the good news is on the right chart, we show that the prime working age population, so those between the ages of 25 and 54, where they've maybe finished college, they're in their working years, they haven't yet started to think about retirement, the percentage of those people, that group participating in the labor force, so looking for a job or working, is the highest it's been in decades. And so that group that you would expect to be working is working. The flip side, though, is that the group that's 55 and above, you can see their participation in the labor market has come down. Part of that is because that group has gotten older. So if you're looking at 55 and above, 20 years ago, they're now 70s and 80s, so they're not expected to be working. But also, they saved well and they retired maybe a little bit early. The Fed estimated that we had about 1 million people who were not expected to retire by 2020 or 2021 to go ahead and retire because of possibly changing um, priorities after the pandemic. And also the stock market did very well. And so they were able to retire. They had a little bit more in savings. So there are lots of reasons for this, but part of it is just demographics. And so this is expected to continue, as we saw on the previous slide with the demographics. We do have an aging population, and we do have not as many people to draw from in that labor market, and so it remains a really tight labor market.
On the top right, I thought when I first read this, I was like, okay, well, obviously that big drop probably was right around the pandemic, and it's not, right? It really preceded that by about a year or so, and then we see another little clip from the pandemic, but and a boost back as we got through that. But yeah, it looks like it's here kind of to stay. Um, this is one I'm going to let you take because I'm afraid to talk about politics right now, and I see Republicans and Democrats. So go ahead, Miranda.
Yeah,
Start a
sure.
fight.
So I'm not going to talk about politics, but we have gotten a lot of questions about this being an election year and what do we do differently with our investments? And our answer would be nothing. The good news is that the economy, so the top chart is real GDP, that's economic growth, and the stock market both do well under both Republicans and Democrats going back all the way to the 40s. We pulled this data. And so the average return on the market is much higher than cash. So the moral of the story is really just don't let your politics drive your investing, because if you go to cash because you're worried about the political situation, you are going to miss out and it may actually impact your retirement. So stay invested through cycles, through leadership changes or status quo. It all works out okay for the economy and the stock market.
And this is, I said I wouldn't talk politics, but I will now. This is the biggest question that we get, and we're going to get it throughout the year as we go into workplaces and talk with people about what's on their mind or what's happening. And in election years, it's we are at our most active. So for anybody on the call who is managing a 401k plan, first off, they probably come to you with these questions first, and it's terrible and it's annoying. But hopefully, you have an advisor who's coming in and talking with these folks, because people are really fearful. And I think that these political divides, as they get greater and greater, these election years become more and more of a challenge for people to kind of see beyond that and look into what actually happens within the economy and within their investments on either side of the political spectrum. So right now is a really active time. This is the time we've got a few little sheets we like to bring in to people to show them. This one's a little bit complex, but we've got some simpler ones that really show the returns and just kind of help us control the narrative with the folks and make sure that they know, even if things don't go their way, the history has shown this works out. So I think it's a good slide. Love this one too. So this is the other thing that we probably get the most calls about, or even the most proactive outreach on our side about, or when bigger geopolitical events take place. Clearly, there's several of them going on right now, and so that in turn brings fear to the investor. And Miranda, talk us through this, because I feel like, without looking at this in great depth yet, what we're going to talk about is a negative reaction to these events when they happen, but perhaps not a sustained negative reaction.
Yeah, that's right. And I think the summary of this slide really is that we've seen a number of negative and concerning geopolitical events around the world over the last 50 years. And unless they really impact our economy for the long term, they don't impact our market. And so we did see a significant sell-off in the 1970s when we had the Israel Arab War, the oil embargo. Our economy was much more dependent on foreign oil. And frankly, the industrial economy was more dependent on oil. And so this sparked inflation. There were a number of things going on outside of just this geopolitical issue, of course, with interest rates and other things. But we did see a material sell-off of 17%, and it took a few years to recover. We did have recessions during that period. It was a difficult time. Since then, however, the market has largely shrugged off some of these very concerning geopolitical events, including the 9/11 attacks, including the Russia and Ukraine war. So initially, the market does react. It's a bad thing. Things have to get repriced. Everyone understands that. There's a lot of fear and uncertainty at the beginning. But then, after on average about 12 days, the market has already recovered to its prior peak from before the event. So this just shows that typically the market sells off over about 9 trading days, which is really hard to think that that's true. It's just 9 days that it really reacts. The average size of the sell off is about 5%, and then it takes just a couple of weeks to rebound. And so, again, there's a lot going on in the world, a lot of really negative headlines, a lot of bad things happening. And that's its own thing, but it doesn't really impact our stock market, especially long term.
Yeah, and it doesn't, because of what you're about to talk about here, and that's the impact of being out of the market. And I'll let you walk through this, but it's incredible to me the significant positive bounce backs that we see immediately following these events. And not just that, but bear markets, recessions. And I'll let you talk through that, but it's pretty powerful.
Yeah, so as we covered the election year concerns, the geopolitical concerns, the main thing is that the stock market long term is driven by company earnings. And so if companies are making money and they're growing, which depends on GDP growth, right, then stocks keep going up. And to try to time coming in and out is very costly. So this chart shows the last 20 years. If you had been fully invested and you didn't try to time coming in and out based on your political party, you didn't try to time coming in based on a recession or a geopolitical event, you were up on average 9.8% per year over the last 20 years. Now, if you got nervous and you missed just the 10 best days over the last 20 years, so lots of trading days there, and you sat out the 10 best days, your return almost gets cut in half. Your average return then goes to 5.6%. And part of the problem is that when there's volatility, you're getting big swings up and down. And so if you're trying to avoid the big swings down, you also miss that big swing up. And it's because 6 of the 7 best days occurred right around each other, like right after one another. And so you can't miss the best days. You can't miss the worst days and still benefit from the best days. In fact, if you sat out for too long, you could actually have negative returns over this period. And so this is just a chart we show to remind you just to stay invested. Tune out the headlines when you're thinking about your investment account. Don't sit in cash and just stay invested for your time period. And you can balance, to Zach's previous question about fixed income, you can balance the risk with fixed income now. And so you don't have to just be sitting in cash. Just make sure you're at your right risk target. You're taking the amount of risk that you can take, that you need to take to retire. And then you just don't think about it until you need to adjust that risk.
Yeah. I think about the pandemic when that came in 2020. There were some headlines. I don't remember who, and nor does it matter at this point, but there were headlines about politicians who apparently knew a little bit more about the severity of what was happening than the commoners, and decided to sell out of their investment portfolios and miss what they felt was going to be that big negative swing. And they did miss it, but I guarantee they didn't get back into the right time. And those of us who just ignored it and moved on are in better shape because of it. And we talk about how they used or abused information, but in reality they just hurt themselves.
Right, because you have to be right on your timing of getting out, and then you have to be right on your timing of getting back in, and that's almost the harder thing to do.
Yep. All right, so let's jump into our trust company's investment process and outlook. Miranda, I will let you start running with this, and I might just jump in with a few questions as you go.
Sure. So I'm just going to provide a quick overview of our overall investment process. So we do rely on a lot of outside research. We do a ton of research when we're thinking about our capital market assumptions and our managers. And so we do partner with some outside research consultants. And then we develop really long-term capital market assumptions. It's really impossible to say what the market's going to do in 1 year. I have no idea what the market's going to do this year. But over long periods of time, returns to investors are stable. So equity investors know what they should earn on their capital that they're investing over long periods of time. Those returns are very stable. So we do forecast 10-year capital market assumptions. That includes return expectations for each asset class as well as risk. And the things that go into return are things like inflation, interest rates, valuations, among other things. So we spend a lot of time thinking about what those things might look like over the next decade. We then use that information in kind of a mean variance optimization model, which just basically tries to optimize your amount of return for each unit of risk that you're taking to focus on the asset allocation, because the asset allocation is really the most important thing in a model. How much risk are you taking? How much return are you expecting to get? And then within that, there are some asset classes where it makes sense to use active managers. So teams of investment professionals who are paying attention and making bets. In some cases, it doesn't make sense to pay for that. The market is very efficient in the US large cap space, for example. But small caps, a little bit less efficient. And so active managers can outperform there. Emerging markets is another example where there's a big dispersion between managers that are paying attention and doing research on regions and countries and sectors and companies. So there's a lot more room for them to outperform the index. And so we do spend a lot of time thinking about managers. We monitor those managers. We fire them when they're not performing well and pick better managers. But that's part of our manager selection process. And then we put all that together. So we think about our growth portfolios and our fixed income portfolios for each participant, and they can select from a blend of growth and fixed income that comes to a risk level that they're comfortable for. So if you're really far away from retirement, you might be an all growth portfolio because you're fine with your account value swinging around a little bit more because it's going to grow at a faster pace. If you're a little bit closer, you might have 20% or 30% in fixed income to kind of smooth the volatility and make the swings less pronounced. So we do blend those together to target various levels of risk. And then, of course, we monitor and evaluate on an ongoing basis.
One thing you've got listed here under the develop section is develop a long-term, a 10-year capital market assumptions. And just for the plan sponsors on the call, I think one of the more impactful things that we can do as advisor is come in and work with those who are 55, 60, 65, and we get the question from them of, look, I don't have a 10-year outlook. This is something where I'm scared to go through one more of these cycles because I'm going to retire in 2 to 3 years. And a big focus for us at that point, as Miranda said earlier, we're not looking at a 1-year timeline. For Miranda and I, who have many more working years, who cares about the next year, right? When it comes to a 401k account and the longevity of that. As you get closer to retirement, you worry about it more, but remember that money is supposed to last you through retirement. So we're still projecting out a 20, 25, 30-year window, depending on what age you retire, that we want that money to be working for you. And so this really is relevant to everyone. It sometimes takes getting in there trying to kind of explain that to them. But Miranda, I will have you take us through our 10-year outlook and what we're looking for here in terms of the asset classes.
Yeah, so I'm not going to go through all of this data, but this is basically our 10-year forecast for each asset class for 2024, and then we show what it was in 23, and then we can talk about whether that increased or decreased. So you can see fixed income had a terrible 2022, not great 2021 either, and then rates went up substantially in 2023. And so while that's painful at the front end when rates go up so much, bond prices go down because those two are inversely correlated. It sets us up for a really nice forward-looking view for fixed income. And so you can see all the green, meaning that in 2024, our expectation of return in fixed income is higher than it was in 2023. So US bonds, for example, our expectation for the next 10 years for each year is 5.7% on average. So this is not 5.7% cumulative. This is just when we get to 10 years from now, we'll look back and say, okay, on average, we earned 5.7% on our bonds. That's what we're expecting. This is a different story than the equity market. So you can see the equity expectations were revised or were moved downward just based on how much things have run up. So valuation, where interest rates are and inflation is today. And so you can see that we adjusted downward the international, developed, and emerging markets. Really all asset classes and equities got adjusted downward based on valuations primarily. And then real assets, a little bit of a mixed bag. Commodities down substantially, but real estate still looking attractive. So these are the inputs into our model when we're thinking about where to allocate. And this is just kind of a snapshot of the returns we expect in 2024 for the next 10 years.
Yeah, and don't let this mislead anyone, because what we're talking about is a lot of green on the fixed income side, a lot of red on the global equity side. But if you look at that 2024 10-year outlook and you look at the bonds, good numbers, but you're going to see some 4s, some 5s, some 3s that are mixed in there in terms of the projected annualized rate of return. Whereas the equity market is still more favorable considerably, 6, 7, 8, 10% that we expect on those returns. So this is not a time to run out of equities and into fixed, but it is a time for us to tell the story to people who are just fearful and trying to move to cash that there are other alternatives. All right, and we have implemented, I believe, a couple of investment changes ourselves within our platform. So let's talk through that. But first, let's talk about the power of rebalancing.
Yeah, so this chart just shows that rebalancing is a risk mitigation effort. So if you start with a portfolio of about 50-50 stocks and bonds and you rebalance it back to target, after 30 years, you're still around 50-50. If you never rebalance it, stocks go up more than bonds. So they become a bigger and bigger share of your overall portfolio than bonds would be. And so it's really important, if you want to be 50-50 or you want to be 70-30, that we are rebalancing regularly to get you back to that target, because otherwise at the end of the year you might be 75-25 instead of 70-30. And so we just take this opportunity to go ahead and rebalance it back and manage the risk there.
And it looks like these are the specific changes that we're making for 2024. Is that right?
That's right. So that slide that we went through on our CMAs, our capital market assumptions, the return expectation, we do use that in making our decisions. And so we did move 5% more into US large caps. We took some out of international developed and emerging markets and some out of real estate as well, and moved some into small caps. And so most of this is just the relative change, right? So we still expect emerging markets to perform better from a return perspective than US large caps. However, the expectation came down a little bit. And so if there is a recession or a global slowdown, US large cap stocks are the most resilient stocks. They have access to capital, they have access to banks and financing, and they have really strong balance sheets. And so part of this was just managing the risk. And part of this was just looking out across the globe and saying that US still looks a little more attractive on a relative basis than it did in 2023 than some of the global markets. If you look at fixed income, we didn't make any changes. And we spent a lot of time actually looking at our fixed income model to justify no changes. We looked at probably 10 different iterations of what we could do in fixed income. But basically, since rates did a full round trip, we decided that we wanted to maintain our duration, maintain the risk in fixed income, and keep things where they were.
Yeah, and in the 401k or the retirement plan space, it's a little challenging, or maybe easier. I don't know which one it is, but we're trying to talk about finding the right investment mix for people from ages 21 to 70. And so clearly we've got to build things out and do so in a way to where we can limit risk across the board. But it is important to have active discussions with participants about these opportunities, because if somebody wants to load up a little bit more on our 10-year thinking about, I'm willing to take more risk because I'm 25 years old, and let's build something out that's maybe a little riskier for better return, projected return over that time, we can get in there and have those conversations and build out that portfolio for that individual. And then generally speaking, you're right. I mean, the asset allocation is important to people. We do find people who don't rebalance, and all of a sudden they're 2 years away from retirement, and now they're 80% equities when they intended to be 60, right? And they don't want to be hit by that big event. So all those conversations are important. Let me check this, Miranda. I think that is going to wrap up our presentation. I cannot see right now, Miranda, the Q&A box. I've got Joanna behind the scenes who I think is sending me information. Do you see any additional questions that I have not asked at this point there?
No questions, Zach.
What's that?
No questions.
Okay, perfect.
Although participants are welcome to add some questions in the chat box right now.
Yeah, you are. And also feel free to reach out to us after this as well. If you want a copy of the presentation, anything like that, just reach out and let us know. But what we're going to do is give you a little break, let you get out of here early and go enjoy your Wednesday, I think it is. Short week, so I'm messed up on that. But it's good to be back with you all. We will be doing this again in the coming months, different topic this time. Also going to probably revisit it at some point this year, Secure Act 2.0 that we touched on last year that passed. There are so many measures in that. Some have already been implemented, some are coming up. So look for some more information around that as well. But in the meantime, have a great morning, rest of your day. Thanks for being here. Thanks, Miranda.